Good afternoon and welcome to today's Dairy Signal. We're happy to have you here on this wonderful Thursday afternoon. Just want to remind everybody before we get started to ask your questions live here with us. And to do so, please click the three dots on the bottom right hand of the video screen and press Ask Questions. Today for the Dairy Signal, we have DLF sponsoring. Success starts with seed. That's why farmers trust DLF, the world's forage seed leader. Backed by cutting-edge research, DLF delivers high-yielding forage products with the traits you need to drive profit on your farm. Ask your retailer about high-performance alfalfa brands like Forage First, 5 Series, and Alfrex Seeds. Learn more at lacrosse.com. With all that, would like to introduce Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company. He is here today to give us another market update. With all that said, I am going to hand it over to Ben.
Well, Amber, thank you as always. It is a pleasure to be here, and we will jump right in and kind of start with what we were talking about behind the scenes, just 5 minutes ago. It's a very complicated world market of all assets, but especially I think raw materials, and especially corn, wheat, and soybeans, and even more so than milk. Start out from a very high level. I don't think there's much to do in the milk market today relative to what we think cash prices are going. We're still very neutral milk. I think that market's been divorced from what's happening in the Middle East for a long time and stays that way. But feed markets, biofuel markets, energy markets, it's very hard to have, I think, clarity beyond the next really week, 2 weeks, certainly beyond the next 3, 4, 5, or 6 months. And so we do want to acknowledge that we are thinking about, the binary situation with nitrogen phosphate-based fertilizer availability in the second half of 2026. It is unknowable today. It is unknowable to some extent how it's going to impact Northern Hemisphere production in 2026. We talked to a lot of people, farmers, end users, companies. I'd say it's going to be hard to separate weather from input applications this year in the Northern Hemisphere. But you do have an evolving issue if we get into the Southern Hemisphere, South American growing season, which kind of kicks off. Planters start rolling August, September there. And if there is a lack of availability of fertilizer, then we've got to think about, I think more so than the impact on yield, it's what do farmers do with, incredibly high input costs? If crude stays where it is, urea goes higher than it is today to the Brazilian, the Argentine farmer. Do they plant just a ton of soybeans? Do they plant nothing? But again, we don't know that. If this is resolved, the other side is, and we'll address this, the climate signals that we're seeing now, famous last words, but I think odds are pretty low we're going to see a major world weather issue, maybe in the next 12 months. And in the US especially, I think we will revisit this in 100 days, but I suspect heat and water availability will probably not going to be an issue for the central US. So you have on the other side, maybe this, growing stockpile of grain. So again, it's just kind of hard to really commit to a directional move in the short and medium terms. But with that said, I think this update, you're going to see that we're going to go through the same cadence of, the topics we've covered for the last 3 months, and that's because prevailing trends so far have been the dominant theme. There is not much new in the way corn supply and demand, wheat supply and demand globally, I don't think, and soybean supply and demand, and especially not milk supply and demand. The milk market is being driven still very intensely by both incredible demand and disappearance, but also larger than expected foreign milk production, especially, and still very large production in the United States. So things are balanced. There's not a lot of urgency on behalf of the end user to chase rallies higher because you can kind of see pretty clearly peak milk supplies in the Northern Hemisphere are just ahead. So I don't think there's going to be a lot of any need to ration or a lot of excitement to chase rallies higher. We're seeing a lot of butter being sold every week, so seemingly we've avoided supply issues there. But at the same time, protein, fat demand is very, very good. One of the bright spots, I think, when we think about agricultural market demand, protein markets are still going to outperform something like corn or wheat on the margin when we think about growth for the next couple of years. So we've done this the last 3 dairy signals, and we're kind of still here. And so the red lines have held. Just when you think that we're entering some kind of bearish trend like last week, we find support, market recovers. So again, still, I think we're going to see this volatility be ongoing in milk, but you know exactly what to do when you're at the upper and lower end of these ranges. I think we can kind of extend this into kind of autumn contract as well. Those have performed better. They are accounting for, like they always do, fewer pounds of milk being produced in the northern hemisphere and globally in August, September. But I still think we're not really seeing the ammunition available to drive SEP Oct Class 3 to $20 a hundredweight. So that is where we would move along hedges, pass off some risk to someone else, I think. And again, I guess too, being very upfront and from a high level, start thinking about or watching Jan-Feb 2027 Class 3 contracts. I mean, I suspect unless you see a big change one way or another with war, demand, production, contraction somewhere, more or less, we're probably going to repeat the last 8 months. And so it is that Q1 2027 always when downside price risk is highest, even when you think it's not. You think this year is different. This year we went to sub $15 Class 3 futures, on a nearby basis. And so do we repeat something like that? That is, I think, what we want to manage even amid all this uncertainty. Otherwise, I think that just kind of keep your head down and produce a lot of milk. Maybe capitalize on feed, milk feed ratios where they exist today. But we do see this, I think, improvement ongoing. We've already seen this, but I think further improvement in physical cash milk checks. And that is not unusual. I'd say that for the most part, over the last 15 years, physical cash milk prices peak in Q4 of any calendar year. And we're probably looking at that again. We're thinking sometime between October, December, probably October, November, when cash milk prices peak. That's usually the case, but I think that happens again. You kind of see in this model, and I think a couple of things is one, Class 3 prices are higher than they were 60 days ago. So that makes sense. But also looking at markets like whey, powder, even I think on the margin, butter has performed a little better than we thought it would, relative to 2 months ago. So you're going to see $2, $3 premiums when we think about cash milk versus Class 3. So it's pretty easy to extrapolate at least where we go for the next couple of months in terms of milk prices. And we're thinking almost the model's exactly 19 in April, 2050 in May, something like that is most probable. So that's, I think, the silver lining to all of this chaos is the milk markets are performing pretty normally. That is positive to price for the next 4 or 5 months. I think at minimum, at least for the first half of 2026, getting into midsummer before we'll kind of reassess what's happening in the Southern Hemisphere, et cetera. But this is the forecast, and I think that makes a lot of sense. And even this aligns with the USDA's annual cash price forecast, which is now above $20 a hundredweight. So I think that USDA's got it about correct. We don't see a lot of revisions forthcoming in the next couple of months. We'll even highlight, I think, the May USDA reports, maybe the first in several months, where they make no changes to dairy or milk supply and demand. So we're kind of found equilibrium, and it explains the back and forth nature of the milk market in particular. We're also looking at, meal prices have been strong, whether it's canola meal in North Dakota, U.S. or Chicago soybean meal, but we're still looking at pretty decent margins in forward months. And this ratio actually has changed very little in the last 30 days. We do like locking this in to some extent, but these graphics are unchanged. And so we get prevailing themes are the dominant, I think, issue for at least the middle part of April. Milked corn, fine, a little better than average, and that probably stays the case for the next 90 days and improves thereafter. But decent milk feed ratios were the case 2 weeks ago, 4 weeks ago, 6 weeks ago. That's still the case today. So again, just looks very, very similar to how it did the last dairy signal. Cattle and beef prices as well. Just when you think that the market's turning over, and really it never really has threatened that at all, we still get confirmation that nothing has changed supply and demand. And in fact, I think, at least for the short term, we've got two things. One, we think corn prices are pretty seasonal because futures markets reflect, at least the perception of physical supply and demand. Dairy markets are also pretty seasonal. Beef, red meat, supply and demand and price even more so. So we're just kind of embarking on what are normal seasonal bullish trends in beef prices. We eat more beef in the summer. That makes perfect sense. That is colliding with a modest tightening of fed cattle supplies, at least based on the USDA's April cattle on feed report. So April 1st Inventory at feedlots down 1% year over year at 11.6 million head. Still very historically tight for this point in the calendar year. Net placements in the month of March were down 7% from last year, so I don't think that this improves anytime soon. And I think that just suggests that dairy beef crosses are going to perform for another 8 or 9 months, the rest of calendar year 2026. So again, that's been a theme for a long time, but there's nothing we see in the data, whether it's cash trade, futures, cattle on feed, meat prices, that suggest any of this changes anytime soon. So it's still kind of left to the dairy operator to band-aid what are very, very tight beef supplies. And so we need those dairy beef crosses for the foreseeable future. So we still recommend continuing to do this, thinking about the other side of this, but I don't think the other shoe drops until 2027 at soonest. But there's still no urgency in milk markets, and that's why those red lines we talked about very front of this presentation are still holding and are probably going to hold. And so you can see that year over year growth in U.S. milk production is retreating because we're starting to compare to some very, very high numbers a year ago, spring, and those numbers probably get smaller as we get into December. I think there is a scenario in that U.S. milk production nationally in December is up only 3 or 4/10%, which is important. Everything is priced on the margin, but we're comparing to all-time record milk production Q4 of last year. So the general theme is that production growth is ongoing. Production in March nationally was 20.4 billion pounds, up 2.3%, but right at expectations. We kind of ended the period where the USDA goes back and revises upward previous production numbers by 30, 40, and 50 million pounds. They didn't really revise anything in their latest report. And so again, for the first time in a long time, I think the USDA's next to WASDE report will be pretty dull in the dairy space. I think cash price forecasts, not any changes, no changes to supply and demand or production or exports or domestic disappearance. We are seeing some kind of slowdown in per cow output. The yields in the month of March were 2,119 pounds, up just 0.3% year over year. It's the smallest in several months. But even assuming that, let's carry that in for the next 2 months, we still have this very large base to work from record national milking cow numbers. And so we're kind of thinking that April production is going to be up about 2% year over year, May 1.7, 1.8%. And so you look at a chart like you see on the right, you're an end user, again, you're just not going to be too concerned about milk supply availability, nor should you. I think we're going to see still very large U.S. milk output for the rest of at least Q2 and Q3, and Q4 may look worse on the margin, but there's not going to be any shortage of milk. And so it's thinking about the flip side of this. Since we've got all-time record cow numbers, the cow herd is expanding like it normally does seasonally, and this is still, I think, a symptom of very, very high margins in places like Texas, Kansas, South Dakota, etc. It's just going to be difficult for us to get to a point in terms of U.S. milk production that we have to somehow curtail or adjust the rate of domestic appearance. So if you kind of flip milk production on its head and think about what do we have to do, what does the market have to do to make all this stuff disappear? And we're doing it very well at the moment. But again, like we've mentioned the last several months is, cheese prices have to be reasonable and competitive, so do butter. Even to some extent, high protein whey probably can't get too expensive or you are going to start to lose tons of demand. And so we're making a lot of things disappear today, but we can't afford any demand contraction. So that's why, again, just more evidence to suggest this neutral pattern of price continues, whether it's milk, dairy products across the board. And I would say, again, I think something that we want people to think about and why we've recommended forward hedges, we're having you think about Q1 2027. It's not the USDA data everyone can see and feel and we get every week or every month. It's what's happening everywhere else, I think, is the insight that we want you to take. To parties when you go out with your dairy producing friends. New Zealand production has been growing really for the last 18 months consecutively. That is not insightful, but I think the last 2 months have been surprisingly large there. We're starting to see cash dairy prices globally, which have been very firm up until about the last 30 days, start to extract premium. And so Europe was the starting point. We'll talk about European cheese prices in just a minute. But even butter in New Zealand, cheese in New Zealand, kind of starting to run out of steam to the upside. I think that's just totally a function of having a surplus of milk available to processing plants. We don't see a lot of weather issues that New Zealand's had to contend with recently, whether too wet, too cloudy, forage production being down. We don't really see any of that for the rest of spring and into summer. European production, we've only got data through February, but they did choose to revise production there in February upward by 200,000 tons. So now, instead of production being up 2%, it is up nearly 5%. And so this is the one market I think that we can see most clearly that there is a lot of stuff available. And so I think this is the second important thing. Number one is, the U.S. is producing lots of milk. Beef prices are going to support producing lots of milk for the rest of the calendar year. It's not bullish at these prices of class 3, but it's everywhere else. And so I wanted to just kind of show you that now, for the first time really since the latter part of 2024, spot cash cheddar prices in Europe and the United States are at parity with one another. And this does align with, just consecutive months of very incredible growth, and in France and Ireland particularly. You're seeing growth in those countries up 5-7% for the last 6 months. And it's starting to now impact the price at which, cheese sellers need to sell their product for to clear inventories. So I don't think that we're going to slow down U.S. physical cheese export disappearance for the next couple of months. But I did want to show you this. And, this is kind of something that we focused very intensely on at AgResource. And whether it's vegetable oil, wheat, corn, soybeans, or dairy, over the course of 90 days, let's say, these price relationships between exporting markets does explain exactly where world market share is changing. And so this is pretty telling. So the black line is the premium or discount that US cheddar has compared to the European market. The blue bars are just monthly cheese exports in tons. And you kind of see that these align pretty well, and even to the point where, late 2024, when European cheese prices started to compete again with the United States, we saw kind of pretty ho-hum export pace. Almost simultaneously, cheese was in the U.S. was priced above the European market. Cheese exports kind of May, June of 2024 dropped immediately and pretty considerably. Then the U.S. cheese market was 60 and 70 cents below the European market, and we're shipping incredible amounts of cheese. We've gone from 33,000 tons to pretty consistently 55,000 tons. And forward guidance is suggesting the two are again at parity. And I think cheese demand as a whole is going to be up, so the impact may be buffered by that. But we're just going to pay more attention to the flow of cheese and U.S. exports, probably April, May onward. It would not be surprising to us if we did see some kind of ding in the U.S.'s share of world cheese trade. So that's, I think, probably the most unique insight we've got for this particular dairy signal, is that we're just not in the same competitive position that we were really for the last 12 months. Things look a little different when we look at global cheese markets. And butter has been kind of surprisingly weak the last couple of weeks, given that stocks are down 17% from last year, at least as of February 28th. And so we're probably hamstrung into not building inventories that much from now until the first part of July. So what is happening, I guess? One, we are seeing world butter markets come down, 5-15 cents per week over the last 30 days. The U.S. butter market is still very competitive. We're going to stay a net exporter. But I think you kind of can check the pulse of U.S. butter supply and demand every week with the USDA's volume of sales report. And so you can kind of see this is just the amount of butter changing hands every week, or a sample size that is then extrapolated into a number. The volume of sales from January 1st to the middle of April, 73 million pounds. A year ago, it was 56 million pounds. So I think it just kind of shows us that there's a lot of butter supply available that's moving around in the U.S. market. In the last 2 weeks, especially, this kind of abnormally high sales volume for the first half of April correlates exactly with the break in cash butter prices. So I guess the message here is butter is not going to trade sub 150 a pound, but there's certainly enough that there's no fear of shortages anytime soon. So we can kind of handle, I think, being a net exporter but also satisfying the domestic market pretty easily. Because I do think this is also reflective of what we're going to see in production numbers. In the last production data that we've got for the month of April, or month of February, we're up over 10% year over year. So I suspect we're going to see similar numbers when we compare this year to last year for March, April, probably May as well. So lots of butter. That explains the sort of neutral nature of butter prices. So again, it's kind of, this is spent a lot of minutes explaining why the trend we have seen in dairy markets the last 30 days is probably the trend we'll see for the next 30 days. But cash prices moving higher, not much to do, I think, from risk management, except for thinking about winter 26, 27. And feed prices, it's kind of every day you wake up to something different that is very clearly driving markets. And so we're just kind of stuck. Again, we want to acknowledge that it is impossible to envision precisely envision the evolution of war in Iran. We don't know about future fertilizer supplies. We know there's a lot of supply at risk of not making it to places like Brazil, Argentina, and the US. Russia's announced it's slowing exports until December because of this growing tightness. And so where fertilizer exists, when you're thinking about the largest exporters being, Russia, China, and the Middle East, those are all places subject to conflict of some degree today. Do these get solved? Does fertilizer price, do they break? I don't think they break until we open the Strait of Hormuz. And, it's who knows when or how that happens. And then kind of catching up on catching up on shipments is the next issue. That may take 6 weeks, 8 weeks, 3 months. At the same time, we know that we've got U.S. stocks data that's very, very detailed. We can see vegetation health indexes, cash prices in a lot of places. And so I think that those markets are also reflecting, whether it's wheat in Russia, U.S. corn at the Gulf, U.S. stocks data that's pretty concrete. We've got record supplies of things today. And even I think when we think about the most recent growing season and the season that's ongoing in Brazil, they're probably looking at record production of, all commodities almost. So you kind of have to contend with this potential issue of acreage being down, productivity being impacted considerably because of fertilizer issues, with just having an incredible amount of stuff that kind of supersedes storage availability in South America and to some extent the United States for the next 90 days. And so which outlook wins? And I think both have been battling pretty intensely for the last 6 weeks, and we haven't really done much in soybeans or corn, adding premium in wheat because they're starting to trade weather. But we do think that protein meal markets, corn especially, are going to be amply supplied for the first half of 2026, probably into summer, autumn of this year. And I think too, weather is going to be most important, which of course it is, it always is. But we've highlighted this before. We've got price models. What drives price? What has driven price of corn, soybean meal the last 3 decades? And it really is the best thing that we can look at is either U.S. ending stocks as a percent of consumption, so stocks to use, or we combine the exporters together and do the same thing. That really explains where markets are and where they're going. So if you look at the last 25, 30 years, we can see that outlooks for corn and soybean meal are kind of bearish if you avoid weather issues. And I think that's still the case given if you go back 20 years, those models account for changes in U.S. presidential administrations, conflicts of varying degrees, all kinds of crude oil prices, and yet the model is the model. And so that would suggest there is downside risk in December corn, November soybeans. I think especially summer and autumn soybean meal contracts. But we've got to look kind of through the daily evolution of conflict in Iran. But again, I think the dogs of the market probably will be protein meal and corn, and I think it's just very difficult for us to see any kind of shortage of protein meal in the United States unless there's just crippling drought in the Midwest this summer. So the U.S. biofuel blending mandate, really focused on biomass-based diesel. We do think that we're going to have to add a few more crush plants to satisfy this. Unlike ethanol, it's very fluid. It can change from month to month because you're not just using corn or I guess sorghum to some extent. You can use tallow, cooking oil, canola oil, soybean oil, any kind of lipid. But I think that we're going to have to use something like 18 billion pounds of soybean oil in the 12 months, let's say ending July 2027. We can do that with expanded crush capacity, but we can't do much more than that. And we have to use, this is the only concrete number that we've got when we think about US biofuel policy and biodiesel. We're going to have to use something like 39 or 40 billion pounds of total feedstocks to make this happen. So the soybean oil market has to encourage imports like we have done in the past. All this can be sorted out. It's just we do have to keep those imports from used cooking oil out of China, tallow out of Brazil, Australia. We have to keep those flows coming to the United States. So soybean oil's got to keep these premiums intact. Soybean oil, we think, is a 60 to 70 cent market. That's where fair value exists. And that's going to keep crush margins very, very strong. They are at $3 per bushel today, both looking at futures and also, actual plants in central Illinois. It's incredibly profitable to crush soybeans. So we are going to continue to produce an incredible amount of soybean meal. And we haven't really seen, I think, the full impact of this. So now, the latest data from National Oilseed Processors Association, 5.4 million tons, up 16% on last year. Jan to March production's up 15%. I think we're going to find new all-time record highs in the second half of 2026. And so where does this meal go, given we're going to have to compete with Argentina and Brazil, after the next 30 days or so? Argentina really ramps up its crush about May, June. Soybean harvest has been slow, but it's going to accelerate. And so it's just going to be hard, I think, to get rid of all this soybean meal. We're not expanding the cow herd. Even the U.S. dairy cow herd probably stagnates where it exists today. So I think meal prices are probably going to, drop 5-10% a couple of times for the rest of 2026. So we're not really anxious to buy soybean meal unless you need it in the short term. Wait for corrections to extend longer term coverage. This is what this looks like. And we're just kind of assuming plants that exist today, nameplate capacity. We can only do something like 94-95% of that, and then planned expansion in 2026-27. The USDA has also done this work. There's really only a couple of numbers that you can come up with, but next crop year, it is just under 2.7 billion bushels. And we're going to utilize as much of this capacity as possible. So this kind of just shows you that we need to produce more oil. The soybean oil balance sheet, in spite of producing 33 billion pounds of the stuff, is not going to be robustly supplied because it's all going to be absorbed by biofuel. But we're going to have a lot of meal to contend with, I think, for the next couple of years. This is what this looks like, just assuming normal soybean meal yields at crush plants. So we're going to add another 1.6 million tons to production, kind of October to September 26, 27. So just kind of the market, kind of like dairy, like corn, flip it on its head. How do we make all this stuff balanced by getting rid of it? It's going to take a price that is reasonable and competitive and profitable for the dairy operation. That's kind of the chore of the soybean meal market, is to keep the dairy operation profitable, or else we're building stocks, which you can't do in something like soybean meal. And there's usually a premium in the U.S. soybean meal market to South America, but it's gotten very wide. And so I think that once you start to see Argentina ramp up crush, they're the largest exporter of meal. They account for about 50-55% of total world trade. It's going to be increasingly hard to clear U.S. inventories at these prices. So it's left to the market or price to sort that out. And I think U.S.'s premium to South America, which today is about $40 per ton, has to drop back to 10 or 15. That is probably going to be reflected in futures and interior cash market. So once we get to the other side of the Argentine soybean harvest, there's just, I think, little in the way of fundamental input to support meal prices where they are today. So we're kind of thinking about just oversupplied markets. What is fair value? You can see it doesn't stay where it is very long. It's not always $250 per ton, but it is within this range of about $255 to $340. We're at the upper end of that range today. I imagine we'll test the middle or lower end of this range second half of 2026. And again, the message is just there's no way we're not going to produce just an incredible amount of protein meal. And I think not only here, but in South America and in Canada, it's all got to find a home one way or another. The growing season also has started, and I think there are going to be challenges regionally getting corn crops planted in ideal dates, whether that's May 10th, 15th, or 20th. Not every state will be able to, see the seamless, very easy planting season. But for the most part, when we think about national planting progress, we we haven't seen much in the way of data, at least, to suggest that's a problem. And I don't know if there's going to be a problem. It could just rain unceasingly in the month of May, and then we'll kind of revisit all of this. But I wanted to show the graphic on the left. One, we've matched or exceeded averages the last 2 weeks. I think given weather to date, at least in the southern U.S., parts of the eastern Midwest as well, we're probably going to get to a pretty normal 25% planted as of this Sunday. And I wanted to show that kind of sort of condensed nature of the planting season. Technology is very, very good. We can plant a lot of stuff very quickly. So we always go through this debate, and the debate is warranted. But the debate is also this kind of 3-week period in the spring every year where outside of 2019, we do tend to get this done. And so I think, too, if we can get the crop planted, weather risks, weather probabilities are such that I don't think we're going to see Midwest drought. I know there's a lot of other factors when determining final yields. Iowa and corn rust there a year ago. So we're not out of the woods by any means. I just don't think it's going to be because of water or extreme heat. I also wanted to highlight that part of the reason national progress is at or above average so far is it's been an incredible amount of work done in the southern U.S. Arkansas is now 82% planted on Sunday. Tennessee 46%, 64% planted, and Kentucky 48%. That's 4 times what they normally plant as of really the middle part of April. And so, on balance, they're going to avoid pollination during the worst part of summer heat. And also, I think that as we'll, again, assess weather, yield potential every week, June, July, unlike soybeans, corn, I think, will be harvested earlier than normal, and also probably in the second half of August in a lot of these states. And so kind of this gap that does usually exist from old crop to new crop is going to be less noticeable because there's going to be a lot of corn in Louisiana, Arkansas, Mississippi, Tennessee, and even Kentucky come August 15th, more than there has been the last decade or so. That's, I think, just something interesting that we want to think about when we think about corn market risks. Fertilizer is one, energy prices are another. But physical supplies, now we can kind of see if we avoid weather issues. Now we're into September where there's just no issues with physical supply availability. And so just think about that as we get into the heart of the weather market. And soybeans, a little bit different just because of, plant biology. But I do think that we've seen just an incredible amount of progress being made in Louisiana and Mississippi, where, like in South America, they can defoliate and harvest whenever they want to. So talking to our clients in Louisiana, it's not that much earlier than normal, but I think they're targeting the last week of July to start things. And so similar concept, especially that location closest to Gulf export terminals. There's not really going to be much of certainly not a rocky transition from old crop to new crop. There's going to be a lot of beans available in the month of August across the southern U.S. So again, we'll see what yields do, how weather performs, but I do think harvest is going to start earlier than normal for soybeans in kind of the far south. Now, we think about weather. We don't have that crystal ball. I wish we did, though it may not be here if we had that crystal ball. I just want to kind of walk you through probabilities. So, when we're seeing pretty intense, exceptional drought still in place in Arkansas and across kind of the western United States, southeast. I think to be real bullish of yield, this has to be eliminated, of course. On the right, you're seeing, one, drought in the principal Midwest has been eliminated completely, in just 45 days. It's been very wet. The forecast from NOAA published last week is they're looking for drought elimination or an improvement in soil moisture really across the entire southeast, especially the major growing seasons, kind of growing regions along the Mississippi River. Even 7-10-day forecasts are very wet in Arkansas, Tennessee, Kentucky. So this probably is going to be proven true sooner than normal. So we do have to contend with a lot of rains needed, kind of Nebraska, Kansas, South Dakota, but everywhere else probably does fine water-wise, at least until we get into end of June. And so if it keeps raining, again, I don't think there's going to be critical water issues in the principal Midwest. And we talked about this before, but just kind of thinking about probabilities of weather patterns, usually you don't have signals that strongly suggest one thing or another. Mother Nature can be very fickle. When we kind of isolate years where El Nino is present, and El Nino officially arrived this week, based on the mathematics of temperatures in this little sliver of the Pacific Ocean. It's not every year. 1991, 2002 were years that corn yield was 5 and 7% below trend. But this does give us the best chance, about a 75, 80% chance that we're going to see trend or above trend yields for corn, soybeans, and spring wheat and wheat in Canada. So you're kind of starting out the process. Again, there's no point in ignoring weather patterns or crop conditions, but just odds are low we're going to see drought in the central United States. Maybe an associated signal is just thinking about spring moisture and weather patterns, March, April. Do they foreshadow summer conditions? And the answer for the most part is not really. But if we do isolate, the Palmer Hydrological Drought Index, kind of a measure of drought, positive numbers are adequate to abundant soil moisture, negative numbers are drought. What happens if drought has been eliminated or does not exist in Iowa in the month of April? And that's what you're seeing on the left. The PHDI in all years but one since 1990 has been positive at the end of July. So this is kind of, again, thinking about probabilities. Wet springs tend to foreshadow adequate rainfall or wet summers. And if you were to do the opposite study, like you're seeing on the right, let's say there is drought present in Iowa, for example, in the month of April, then you kind of less odds are 50-50 you have drought in Iowa in July. So I think that, again, you don't get any precision on forecast just because of what you know in April, but it does, again, tend to foreshadow a continued absence of drought, at least into the middle part of summer. So that's why we say we can get crops and seed in the ground. I don't think that those seeds at least will have issues with water availability. That's at least the starting point here. So thinking about seasonal trends in price, to be honest, and we'll kind of wrap this up with that, it is not unusual for corn and wheat and soybeans to rally in the month of April. That is pretty common. It is equally common for major row crop markets to break pretty hard in summer if there are Midwest weather threats avoided. And even something like 2019, if you remember, very quickly, the market rightfully was concerned about planted acreage as a whole, seeding dates, the impact on yield. First half of summer, until you got to a point where we were losing demand and the market broke and didn't really look back. So it's just very hard. You got to have drought like 2012, 2011 to, I think, sustain price rallies during summer. That's not even insightful. That is just how it's worked the last 20 years. So again, if you're not experiencing drought in Iowa in the month of July, maybe rallies in the feed markets do start to struggle because perception is that we're replenishing global inventories, just 2 months down the road from that point. Energy markets, though, are, I think, giving a boost to ethanol production margins and especially blending margins. I think this will help cash bids. So again, the high-level actionable advice is to the biofuel plant, the processing plant's going to be your best bid for corn and soybeans, to be honest. The problem, though, is we've got, every week we get data from the EIA, pretty concrete ethanol production disappearance, stocks data, official corn use for ethanol from the USDA every month. And so just putting those together, the issue is we get gallons produced every week, and we're no longer dividing that by 2.9, ethanol yields from a bushel of corn. We're dividing that now by 3.08 or 3.1. Efficiency's improved, ethanol yields from corn are getting better, and we're still just using an incredible amount of sorghum. So and just the hard math is what you're seeing on the right. It's just not enough to meet the USDA's forecast yet. And so we're thinking the domestic market's probably not going to add to total U.S. corn demand in 25, 26. In fact, could, in the end, add something like 50 or 75 million bushels to in stocks just because running at full capacity, we've gotten very good at making ethanol from corn, and we have a lot of availability of sorghum in Texas and Kansas, and so the math is what the math is. We also, on the other side of this, again, thinking about markets from now until August at least. Fertilizer is a whole other issue, energy markets, but physical supplies from now to August, how does the futures market react to this? Probabilities are low that we're going to see Midwest drought. We've also got something that we really can't strip away from the market at this point, and that's very, very large Argentine corn production. They're only 25% harvested between now and the first week of June. It's going to move very, very slowly. They'll get to 30% complete on May 1st, then only 50% complete on June 1st. They're doing 3, 4, 5% every week. But so far, the actual yield of Argentine corn as of last week was 8.75 tons per hectare. The yield on the 300,000 hectares harvested last week was actually 9 tons per hectare. And so we're starting to raise the average. This is up 5% from last year. USDA is 5% below last year on their total Argentine corn yield. And so those are very much misaligned. And so we think that if corn yield on a weekly basis does not change between now and July, you are left with a 61 or 64 million ton Argentine corn crop. So I wanted to show what this looks like. It was kind of like, and I know there were issues with the US corn crop in the end last year, but when the crop tour started and you're just looking at, plant counts and you're pulling ears and how good those ears looked, and everyone's kind of like, whoa, this is a very special crop. Similar kind of vibe in Argentina at the moment. They got a lot of late season rain. They got actual yields performing very, very well. Yields when you separate the weeks are getting higher, they're not getting lower. So, again, it's going to take a while for their market to be replenished domestically, but we're concerned for, physical supply and demand that Argentina is going to take away from the US's share of world corn trade, which has been the driver of price and has been incredibly large as it's ever been. 3.3 billion bushels we are going to export in crop year 25-26. I think maybe just because of the math surrounding South American corn production, you probably have to lower this 400, 500 million bushels or so next year. So as always, it's balance sheets. There's a lot of numbers here. None of our forecasts will be proven exactly correct, but the general theme is still that we're going to plant, not 92 million acres, but probably 95. We expected 92, October, November of last year, but that's just not what NASA's survey found. So you're assuming trend yields, trends in domestic consumption. I think you got to trim exports just because of what we're finding in Argentina so far. And just kind of left with this very dull balance sheet. We are like normal. Everyone's going to lose their minds over yield forecasts, crop ratings, weather conditions, et cetera. But we wanted to communicate to you watching this that unless the perception in the market is that U.S. corn stocks are below 1.5 billion bushels or above 3 billion bushels, we're kind of stuck with the market we've had for the last 12, really 24 months. So be careful as we're chasing every single weather forecast, yield forecast. A lot of people pitching their positions. Our idea is just that we're kind of stuck here, and there's really nothing exciting unless there is just cripplingly bad weather, central Midwest, from June 1st to August 31st, which may be the case, but doesn't seem like it will be with what we know now. And soybeans as well. I think the soybean oil story is very interesting. I think it went to the fair value that is elevated very quickly, but now maybe we kind of plateau. And it's just kind of hard to reconcile soybean oil at 75 cents. And I just don't think it's necessarily bullish to soybeans because it's similar to ethanol, which, the EIA publishes every year. This is capacity. We can't produce more ethanol than this. And so you kind of know what you're dealing with when thinking about industrial corn supply and demand. Crush is expanding. It's going to continue to expand, but it's also finite. And if we were to expand it further, how many years is it from permitting to production? I don't know if it's 2 or 3. It's going to take time. So we're going to crush an incredible amount of beans, but we also can't crush in 26, 27, more than 2.7 billion bushels of the stuff. So still, if weather is good, we still have to find demand in the export market. And so how are we doing with China? Are we friends? Are we not? What is South American production? And so most likely we are building soybean stocks. But I do want to say that given all the uncertainty, crude oil, Strait of Hormuz, U.S. biofuel policy, which is positive, I think this is all weather. Not insightful, I know, but if yield is 53.5 or better, I think one is bearish soybeans. If the perceived yield, though, is below 52.5, then one is bullish of soybeans. And so there's not a lot of margin for error here. I expect volatility in the soybean market, at least for the next 100 days or so. I also wanted to touch on hard red wheat, which has been a disaster. And we're trying to determine now whether that last weekend's frost did a lot of damage to the crop. And certainly it wasn't good, but I guess the message we're getting back is it's hard to identify. The crop looks very bad in this farm, but is it poor establishment? Is it drought? Was it freeze? It's gone through everything that you can throw at the crop, and it's all been pretty negative. So we are ratcheting down hard red yields pretty significantly. I think ultimately this will be sub 40 bushels an acre. I guess the issue though is we're carrying over an incredible amount. We're half of a crop, 450 million bushels. We're starting the season with. And then we just want to be careful with wheat. I know it's not relevant to the upper Midwest, but its impact on world grain prices is this is certainly a supply-driven issue. The scramble from millers to secure high-protein wheat is driving prices up, and that makes perfect sense. I would do the same. But ultimately, we're kind of going to run out of steam unless there's a production issue elsewhere. And the problem that we've got, I think, is today, wheat in the Southern Plains is still $40 a ton above Russian origin. It is $35 a ton above corn in Garden City, Kansas. So it seems like we're going to be solving some of these issues pretty quick. So as you take production down of hard red, by 200 million bushels from last year, a very small crop. You're also taking down total consumption by 75, 100 million bushels, and we're carrying over a lot of stuff. So how high is high in Kansas City? Not quite sure, but I do think that the upper end of the range maybe lower than it could have been 3 years ago, 4 years ago, because we've just still got a lot of high protein wheat on Earth. It's very early. This is what Russian and Ukrainian and Romanian vegetation health looks like compared to average. It looks very, very good. We're kind of out of categories to display this in eastern Ukraine and southern Russia. This is the heart of the Black Sea wheat belt. And even Russia, Romania, and Bulgaria produce about as much wheat as the U.S. does when we look at the hard red balance sheet. So they collectively produce 8 or 9 million tons. The hard red crop's about 8 million tons. So all this matters. We also want to say, it's very early, but if it rains an inch in April in southern Russia, we've identified the 4 largest producing oblasts there. You're more or less guaranteed a pretty decent winter wheat crop. If the sort of 5-day forecast is correct, they're going to get about 2.8 inches of rain in the month of April. So I don't know. Yield risks are not off the table, but it does seem like this wet pattern, mild pattern in Russia, they're already solving some issues. We're taking some supply risk off the table here. And this is what hard red looks like compared to everyone else. So if we look at to July, the new crop season, $46 a ton above the world's largest exporter and the benchmark wheat market on Earth. And like cheese, you can pretty clearly plot hard red export sales on top of this blue line, and you can see it matches very well. When there is a $50 per ton premium, we sell very little hard red into the world export market. When you're at a discount to Russia, we sell a lot of hard red wheat to non-traditional buyers. Today, exports are very bad. I don't think they're going to improve anytime soon. So we are kind of solving our supply issues domestically by, so far eliminating new crop U.S. hard red wheat export demand. Probably going to lose a little bit of feed demand as well in places like central and western Kansas, given that corn is again at a discount to hard red wheat. This is kind of where we leave things. Again, talking about seasonal trends. There's a lot going on. Like I said, the most important thing is it's hard to have clarity beyond the next, 60 days, 90 days. We're getting into a weather market. But will it be hard to separate, at least in corn and wheat, all of this chaos that's happening geopolitically from normal seasonal trends? So, like I said, even the wheat market breaking in March and recovering in April tends to happen. Why that specific trend has been established, I don't exactly know, but we just haven't done much unique in the grain markets yet. So I think it is if you're producing corn, you're producing wheat, or even soybeans. We just want to be mindful that at some point in the next 30 days, markets tend to break as we take supply risk premium out of price. And so we do want to think about, it's setting orders above the market. We just want to hedge forward to some degree by the middle part of May. And I think that's kind of all we can say about grain markets. And we don't really want to touch 2027 yet because there is a lot of uncertainty. So again, it's lots going on as always. I think the dairy operation does pretty well for the rest of the calendar year based on rising milk prices, still reasonably priced feed. It's just the energy prices is what we're, again, don't have a lot of vision on because of what's happening in the Middle East. So thank you. Questions, rebuttals, complaints are welcome now or at any time in the future. My email address is right here.
Alrighty, well, thank you, Ben. You covered a lot today. What are a couple key messages or takeaways that you want our listeners to take home with them?
Yeah, I think it's still the case. It's all about risk management. And so for feed markets, it is kind of unknowable. We like where margins exist today, so I don't have a problem. Maybe on the next correction, buying a bunch of corn, buying a bunch of protein meal, you at that point don't have to worry about the Strait of Hormuz for a couple of months. And in milk, I think it's just again balance. Market's behaving completely normal. That is a positive for the next 6 months milk pricing. But just think very, very hard about Q1 2027. We want to keep these margins intact, keep this thing going. That is where I think the risk lies. But other than that, it's sort of just produce as much as you can. That is still the message from us.
Alrighty, well, perfect. Thank you. And we want to thank everybody at Ag Resource Company for their continued support of the Dairy Signal. And we look forward to seeing you next week. Have a great weekend.